MF Global Holdings was, by late 2011, one of the largest futures commission merchants in the United States. A futures commission merchant, or FCM, acts as an intermediary. Farmers, mining companies, airlines, and speculative traders all use futures contracts to hedge price risk or make directional bets, and an FCM clears and carries those positions on their behalf. The firm traced its commercial roots to Man Group, a British trading house with origins in 1783, and it had gone public on the New York Stock Exchange in 2007, with shares pricing near $30 on its first day of trading. By the spring of 2010, the stock was hovering near $7, and the board was looking for new direction. In March 2010, MF Global hired John Corzine as chairman and chief executive. Corzine was not an unknown figure. He had served as co-chairman of Goldman Sachs in the 1990s, then as a United States Senator from New Jersey from 2001 to 2006, and as governor of New Jersey from 2006 to 2010. His stated goal at MF Global was transformation. He wanted to convert a mid-tier brokerage into a full-service investment bank capable of competing with the largest Wall Street firms, and he sought a primary dealership from the Federal Reserve as a marker of that ambition. That vision required revenue that the brokerage business alone, squeezed by low interest rates that compressed returns on customer cash balances, was not generating. The European sovereign debt crisis escalated sharply in 2010 and 2011. Greece, Ireland, and Portugal accepted rescue packages from the European Union and International Monetary Fund. Spain and Italy saw their borrowing costs rise as markets priced in the possibility of wider contagion. Corzine, drawing on his years trading government bonds at Goldman Sachs, believed the market was overestimating the probability that Italy or Spain would actually default. Both were large, deeply integrated Eurozone economies, and he argued internally that the European Central Bank and Eurozone governments would ultimately backstop them. If he was correct, the wide yield spread between Italian bonds and German bonds represented an attractive carry that could generate the profits MF Global needed to fund its expansion. To build this position without tying up enormous capital on MF Global's balance sheet, the firm used a structure called a repo to maturity. In a standard repurchase agreement, a firm buys a bond and simultaneously agrees to sell it back at a set future date, effectively borrowing against the bond as collateral and keeping it on its books. In a repo to maturity, the repurchase date is set to match the bond's own maturity date. Under accounting rules in place at the time, as described in subsequent analyses by accounting scholars and in regulatory filings, this structure allowed MF Global to treat the transaction as a completed sale rather than a financing, remove the bonds from its balance sheet, and book the entire profit margin immediately. The result was that MF Global could hold billions in European sovereign bonds while reporting a far smaller apparent exposure to outside observers. The Financial Accounting Standards Board issued an update to those rules in 2011. But the effective date came after MF Global's collapse. Through 2010 and into 2011, MF Global's repo to maturity book expanded steadily. By the summer of 2011, according to the CFTC's subsequent enforcement documents and congressional testimony, the firm's gross exposure to sovereign bonds from Italy, Spain, Portugal, Ireland, and Belgium had grown to approximately $6.3 billion, a figure that represented several times the firm's total equity. Internal risk managers raised concerns about the size and concentration of the position, and at least one senior risk officer departed during this period. The Financial Industry Regulatory Authority, which oversaw MF Global's broker-dealer subsidiary, had also pressed the firm to raise additional capital as a cushion against potential losses on the European holdings. The crisis arrived in the last week of October 2011. On October 24th, Moody's Investor Service cut MF Global's long-term credit rating to Ba3, the lowest investment-grade notch, one step above junk, citing the concentrated sovereign debt exposure. The following day, MF Global reported a third-quarter net loss of $191.6 million and disclosed publicly for the first time the full scale of its European repo to maturity book. Those disclosures triggered a cascade. Institutional clients began pulling accounts, counterparties demanded additional collateral on existing positions, and the rating agencies signaled further downgrades were under consideration. Within days, the firm had burned through its available liquid assets trying to meet those demands. Under rules administered by the Commodity Futures Trading Commission, futures brokers are legally required to hold customer funds in segregated accounts entirely separate from the firm's own capital. This segregation is the foundational protection that allows thousands of traders to use a single FCM without worrying that the broker's own trading losses will consume their deposits. According to findings by the CFTC and court-appointed trustee James Giddens, MF Global transferred funds from customer segregated accounts to meet the firm's own proprietary margin calls and operational shortfalls in the final days of October 2011. The shortfall in customer accounts at the time of the bankruptcy filing was approximately $1.6 billion. On October 31st, 2011, MF Global Holdings filed for Chapter 11 bankruptcy protection in the Southern District of New York. The filing listed roughly $41 billion in assets and approximately $39.7 billion in liabilities, making it one of the largest corporate bankruptcies by asset size in United States history up to that point. Approximately 38,000 customer accounts were immediately frozen. Potential acquirers, including Interactive Brokers, had spent the prior weekend in acquisition talks, but those discussions collapsed on the morning of October 31st when the scale of the customer fund shortfall became apparent to the buyers. The freeze left commodity producers, hedgers, and small traders unable to access positions many had held for operational purposes entirely unrelated to speculation on European debt. John Corzine testified before the Senate Agriculture Committee and the House Financial Services Committee in December 2011. Under repeated questioning about where the customer funds had gone, he stated that he did not know and that he had never intended to authorize the misuse of customer money. The Department of Justice conducted a criminal investigation that did not result in charges against Corzine. The CFTC filed a civil enforcement complaint in 2013 alleging that Corzine had directed a subordinate to transfer funds in ways that drew on customer accounts, a characterization Corzine disputed. In 2017, Corzine settled the CFTC's civil case for $5 million and accepted a lifetime ban from registering with the CFCC or acting as a principal in commodity pools. The recovery of customer funds was slow and procedurally complex, in part because assets were spread across both a broker-dealer subsidiary and the futures commission merchant. Trustee James Giddens oversaw a multi-year process of liquidating assets, pursuing claims against financial institutions that had received large transfers in the firm's final days, and distributing proceeds to customers. Commodity futures customers ultimately recovered close to 100 cents on the dollar, according to reports filed by Giddens' office, though the process stretched across several years in multiple court proceedings. That delay imposed real harm. Farmers and commodity producers who depended on their futures positions to hedge grain and energy prices found themselves locked out of those markets during a period of elevated volatility. MF Global exposed a specific and consequential gap in futures broker oversight. The CFTC had long required segregation of customer funds, but had allowed FCMs to invest those funds in a range of instruments, including under a provision called Rule 1.25, in certain foreign sovereign debt securities. After MF Global, the CFST amended Rule 1.25 to sharply restrict the eligible investment universe for customer funds, limiting it primarily to United States government securities and a narrow set of highly liquid instruments. The CFTC also imposed more frequent and granular reporting requirements on FCMs so that regulators could monitor customer fund balances on a near-daily basis rather than waiting for periodic statements. The MF Global case is a useful reference point for anyone who holds assets at a futures broker or a brokerage firm more broadly, because two separate protection frameworks exist. At a securities broker-dealer, the Securities Investor Protection Corporation, known as SEPC, provides up to $500,000 in protection against firm failure, including up to $250,000 for cash. At a futures commission merchant, there is no SIPC equivalent. Instead, customer funds are protected by the legal segregation requirement itself, meaning the firewall between customer money and firm money is the primary safeguard. When that firewall is breached, as it was at MF Global, customers become unsecured creditors of a bankrupt estate. Recovery is possible, as the MF Global trustee process ultimately demonstrated, but it is neither guaranteed nor fast. Understanding the difference between a securities account and a futures account, and knowing which type of institution holds your money and under what regulatory regime, is a practical piece of financial literacy that the MF Global episode made sharply clear.